Happy New Year, ADK Wealth Advisory Group and Financial Planning World Community. Dan Davis, President, co-founder, coming at you from our Franklin, Tennessee office. And purpose today really is to summarize the year and look forward to 2026. You heard me in Q2's market update say it's been the weirdest year of my close to 40 years doing this, and I would say that's really accurate. If you take a look at economic growth, for example, Q3 GDP up 4.3%. Expectations were 3.2, so more than 1% exceeding. And if you look at Q2, it was 3.8. So we've seen a growing economy versus a growing economy that's had shrinking growth. And some of that's a little bit weird because you take a look at Q1, which was tariff driven, had a negative 0.6%. So call it, down almost 2/3%. On an average, about 2.5%. So mixed data. But clearly you heard me saying at the beginning of the year, lots of talk about recession, all this talk about recession when the tariffs were going on. And I was basically saying the data doesn't support it. And I would say that data is accurate. We didn't have a recession. As a matter of fact, we have very solid GDP growth. And I would say that the data and corporate earnings would say that there's a very low, if any, risk of recession in 2026. Barring some kind of a major shock. And when I talk shock, I'm not talking tariffs. I'm talking something like, the 1970s oil embargoes, that kind of shock. And what's driving the GDP? It's really three areas. One is the top 10% of the consumers are spending like crazy. And you take a look at the next AI spending. While Q3's AI spending cooled, it's our expectation that AI spending will continue. And then the third would be healthcare spending. And not a big shock when you take a look at the baby boom. They're now starting to see a lot of healthcare expenses. That trend will continue for a while as well. Consumer spending, let's unravel that a little bit. So if you take a look at my family that I grew up in that lives up in, say, North St. Louis, that group is part of the group that's being hit by this inflation-driven economic problems because they're not seeing income grow above the inflation rate. And as a result of it, they're suffering while the people that I'm part of, that top 10%, and you as my clients are in that group, we're not really feeling the squeeze the same level. And I think that trend continues. AI spending, you hear a whole bunch of nonsense about AI is going to go away and it's just a trend and a fad, blah, blah, blah. In an interview between CEO for NVIDIA, Jensen Huang, he really, I think, commented so brilliantly, and that is that it's a trend that's here to stay. But no one exactly knows, including him, and he's at the top of the heap, where it's going to go. I liken it to if you rewind your mind back to dial-up internet, and you think about what was that like, that's where we're at right now with AI. Maybe a little bit ahead of dial-up internet, but not much. And where's internet now? Where will AI go? No one really knows. I hope they put some guardrails up so that it doesn't end up being in a position where it takes over things. But the reality of it is the genie's out of the AI bottle and it's here to stay. Inflation, I started to pull thread on that. Let's do a little bit more. The Federal Reserve has a target rate of 2% inflation, just not going to be able to meet that. You take a look at inflation expectations for this year, Q4 hasn't been reported yet, but it's hovering around 3%. And I think that it's going to be really sticky at that because the major trend that's going on is deglobalization. In simple terms, manufacturing is moving away from China where it's super cheap, and it's either being reshored or it's being friend-shored, or it's being put somewhere else in Asia that is less hostile to capitalism and our democracy. And what does that mean to you? One of my clients kind of summed it up to me in a conversation who does pharmaceutical consulting. And he said, if you've got a project that's being done in China that costs you $1, you bring it back to the States, it's going to cost you 3 to 4. Now, not everything is going to get brought back to the U.S., and not everything that comes back is going to be 3 to 4 times, but the increased cost is there. So it's going to be very, very difficult for the Fed to meet their 2% target. As a matter of fact, I think somewhere along the line, they'll be forced to come out and say that they have a new target and the why behind it. It's problematic because Trump's interfering and trying to bully them into lowering rates. And that's not the thing to be doing when you have inflation that's sticky. The economy is growing well enough where I don't think the Fed's going to have to lower rates nearly as much as it is what the market would hope it will do next year. But I still think it'll be in a glide path of lowering rates for a while. So at the beginning of the year, I expected that bonds would do somewhere between, say, 4 and 7. They've been at the top end of that. And then stocks, I expected somewhere, 9 to 11. They've exceeded that. If you take a look at what stocks should have done, should have been about 10 or 11. The incremental growth is what I call PE expansion. It just means that people are willing to pay more for something. At some point, that PE expansion gets either A, pulled back in a market downturn, or B, earnings push it forward to get caught up. That's what's been happening, which has been really surprising to me because I've never seen that happen. And it's really been tech/AI. What's the expectations for 2026? You heard me say no recession, unless there's a shock. Probably no recession in the first half of 2027, but more on that as more data comes out and we do future market updates. I would expect bonds to do around 6, and I would expect stocks to do somewhere 7 to 11. Anything above that's going to be, again, PE expansion unless earnings really shock us. Now, what concerns do I have? I do have concerns. They're not necessarily concerns for 2026, but they're concerns for when we do have a recession. And every economic cycle has a recession. And the concerns really are, number one, would be crypto in how prevalent it's now becoming inside of our overall economy. I'm not opposed to crypto. I invest in crypto periodically. But the thing that concerns me is you've got a president that now is worth more in crypto than he is in real estate. And that's a whole nother conversation. But the reality of it is that the mainstay creep of crypto, which is a speculative asset, into a lot of other different systems means that when we have a recession, maybe not the next one, maybe it's 2 or 3 out, and you have a speculative asset that blows up, while it'd be a great buying opportunity for that speculative asset because crypto's here to stay, it's going to create problems inside the main street. Second would be what I would classify as shadow banking. You might have heard this before, but you had Tricolor and you had other major players that went bankrupt. And normally you'd be able to see some of that coming because they would have been lent money by publicly traded banks. In those private or publicly traded banks, you'd be able to see the loan. But in the shadow banking, it's basically private institutions or private equity lending money. And that's a global phenomenon right now. In that will create problems. What's going to look like, no one knows because this is the first generation of that kind of shadow banking. Another would be just what I'll classify as private AI spending, not public traded stocks because they have great earnings. It's the amount of private money that's seeking to find the next NVIDIA or seeking to find the next ChatGPT. The multiples in that space and the amount of money is staggering, and that's going to have problems. It will probably creep into the market again, like the crypto. Will it be in the next recession, or will it be 2 or 3 out? No way to know. And then the last area of concern would be geopolitical. When you take a look at things like when you have geopolitical shock transition like what we're in, it creates a lot of uncertainty. And the biggest thing that concerns me about all of that is the stranglehold that China has on rare earth mineral processing. And just like a lot of the things that have been ridiculous that we've allowed China to have so much control over because they've been greedy and cheap, trying to get cheap cost of things, they control somewhere between 85 and 100%, depending on the rare earth. And that stranglehold's significant when you're trying to do things like technology or some simple smartphones or defense. I mean, the magnets that need to be done in these fighter airplanes and missiles and all that, I don't understand it, but it's significant. And then obviously you've got the green space as well that's affected by it. And it's going to take, from my reading, 2 to 5 years for America to be in a position where we can actually do that. And that assumes that we lighten EPA concerns to be able to allow real nasty, dirty, polluting process to happen. So hard to say how all that plays out, but I don't like the fact that so much has been done and pushed towards China that deglobalization is what I'll classify as a big geopolitical concern of uncertainty. So, but again, it doesn't concern me for 2026 relative to stock market and recessions, but it does concern me at macro views. My outlook is no different than what I just reiterated. Stocks, bonds doing well, lots of volatility like we saw this year. And if I'm going to wrap it up, I'll just wrap it up by saying thank you for trusting us in a real dicey 2025. It's truly my pleasure to be in a position to hold your trust and knowing how important my team's role is in your life. So thank you very much. I hope your holiday season has been blessed. Mine certainly has been. So we're signing off from Franklin, Tennessee.